Recently, there have been a plethora of bad news in the global primary market. First, Blackstone, the top private equity firm, experienced a wave of redemptions in its $60 billion Bright Fund at the end of 2022. Following this, the $70 billion BPP fund also received redemption requests equivalent to 7% of its total assets under management. In February 2023, Blackstone announced a default on its €531 million bond. Subsequently, on March 10th, Silicon Valley Bank was shut down by regulatory authorities due to a bank run. Focused on the technology sector, Silicon Valley Bank was the 16th largest bank in the United States and one of the most popular banks for many startups. For biotechnology companies that rely on financing for support, this situation presents an even greater risk. It is difficult to imagine how biotech companies in the primary market can raise funds in such market conditions, especially for those in later stages. A medical industry investor told Zhongtu Network that under the current market conditions, the ability to raise funds through Hong Kong's Section 18A has been basically lost. He explained that companies that went public earlier have substantial cash reserves, but for those that have not yet gone public, it is more difficult. BA data shows that in 2022, the total amount of global biopharmaceutical investments and financing decreased by about 38% year-on-year, while the total amount of medical device investments and financing decreased by approximately 35% year-on-year. Evidently, everyone's cash flow is tight. Unlike the subprime crisis of 2007, the collapse of Silicon Valley Bank was not due to any high-risk operations on the asset side. Everyone agreed that the bank's asset quality was good. As a result, the Federal Reserve could confidently assure that the rescue of Silicon Valley Bank would not require a single cent from taxpayers. The bank's demise was due to the sudden disappearance of cash. Financial reports show that in 2019, the net inflow of customer deposits at Silicon Valley Bank was only USD 12.4 billion, which grew to USD 40.2 billion in 2020 and further increased to USD 78.2 billion in 2021. Following the COVID-19 pandemic, the deposit scale of Silicon Valley Bank doubled. However, in 2022, the bank's deposits suddenly dropped to a net outflow of USD 16.1 billion. It seemed that nearly $100 billion in cash disappeared overnight. Some people attributed the cause of the Silicon Valley Bank incident to a massive PR disaster, where asset sales were misinterpreted by the market as a funding break, leading to a bank run by depositors. Others blamed the situation on some Silicon Valley VC tycoons who irresponsibly instructed their invested companies to withdraw deposits, causing the situation to spiral out of control. However, these were just the last straws. The dramatic plunge in Silicon Valley Bank's customer deposit scale in 2022 revealed the rapid disappearance of cash in the entire U.S. VC ecosystem. This was a grain of sand that fell on Silicon Valley Bank's head, symbolizing the times. Going back to March 2020, the Federal Reserve held 2 emergency meetings in a panic, lowering interest rates to a historic low of 0.25%. A few months later, a flood of money began to pour into the U.S. VC ecosystem. Data from the NVCA shows that in 2020, U.S. VC funds raised 17% more than the previous year. In 2021, the amount of U.S. VC funds continued to grow by 46%, reaching a historic high of $1.3 trillion, NVCA data. Subsequently, capital flowed from VC funds into startup companies. In 2021, the scale of U.S. VC-backed venture capital transactions worldwide reached $683 billion, doubling from 2020, NVCA data. As a result, an era described by a certain VC mogul as the most prosperous time in my 20-year career had arrived. The golden era came to an abrupt end in 2022. U.S. VC fundraising dropped by 40%, returning to pre-pandemic levels, and correspondingly, U.S. VC investments also decreased by 36%. NVCA data. Due to the plunge in the U.S. stock market, the exits of U.S. VCs reached a freezing point, with the total exit amount in 2022 being only $71.4 billion, a 90.5% decline year-on-year, NVCA data. In summary, in 2022, U.S. VC fundraising was approximately $500 billion less, Investments were about $200 billion less, and LPs received around $600 billion less in exit returns. To a certain extent, it was the collapse of the venture capital ecosystem that led to the downfall of Silicon Valley Bank, rather than the other way around. This implies that the situation is far from over with the recovery of deposits at Silicon Valley Bank. Bridgewater Associates founder Ray Dalio referred to the Silicon Valley Bank incident as a wake-up call on March 14th, believing it would trigger a chain reaction across the entire VC sector and even beyond. Another Wall Street tycoon, BlackRock CEO Larry Fink, stated in an investor letter on March 15th that the collapse of Silicon Valley Bank is just one domino, and the next ones to fall could be funds investing in illiquid assets, such as private equity and real estate, particularly those leveraging to increase investment returns. To illustrate the issue, let's look at a specific example. Biotechnology is also one of the key industries served by Silicon Valley Bank. In the deposits of Silicon Valley Bank, 12% belong to the healthcare and biotechnology industries. The bank has stated that in 2022, it provided banking services for at least half of the healthcare startups supported by venture capital funds. Therefore, the decline in financing activities within the biotechnology industry is one of the main reasons for the loss of deposits at Silicon Valley Bank. More than 10 Hong Kong-listed biotech companies, such as BeiGene, Kindred Bio, Zai Lab, and Ascentage Pharma, have named Silicon Valley Bank as one of their main banks. After the incident, these companies successively announced their deposit situations with the bank. As Silicon Valley Bank has fully resumed withdrawals, these companies no longer need to worry about deposit losses. Interestingly, although these companies have stated that their deposits in Silicon Valley Bank account for a small percentage, the proportion in their market value is not low. For example, Kindred Bio announced that as of March 12th, it held approximately $11.8 million in deposits with Silicon Valley Bank, accounting for only 6.5% of the company's cash and cash equivalents. Therefore, Kindred Bio stated that the impact on the company's operations plan is minimal. However, the $11.8 million, when converted to Hong Kong dollars, is over 90 million Hong Kong dollars, which is equivalent to 1/10 of Kindred Bio's current market value. Based on this calculation, Kindred Bio's market value is already lower than the company's cash and cash equivalents on the books. The valuation inversion is quite severe. Prior to its IPO, Kindred Bio was valued at 4.7 billion yuan, but its current market value is only 900 million Hong Kong dollars. Kindred Bio is not the only company in this situation. Research by China Venture found that since 2021, biotech companies listed on the Hong Kong Stock Exchange under Chapter 18 have seen their market values shrink to a fraction of their pre-IPO valuations. For example, BeiGene, which was mentioned earlier, had a pre-IPO valuation of 3.4 billion yuan, but its current market value is only 850 million Hong Kong dollars. Baixinan had a pre-IPO valuation of 3 billion yuan, and its current market value is 1.1 billion Hong Kong dollars. This will undoubtedly impact their ability to raise additional funds. A review of the financial reports of these named Hong Kong-listed biotech companies shows that their cash reserves have been declining throughout 2022. For biotech companies that rely heavily on financing for their operations, the current market conditions pose an even greater risk. It is hard to imagine how biotech firms in the primary market can raise funds, particularly for those in later stages. A healthcare industry investor told China Venture that, given the current market conditions, the financing capacity of biotech companies listed under Hong Kong Stock Exchange's Chapter 18 has been significantly weakened. He pointed out that while previously listed companies may have substantial cash reserves, raising funds for unlisted companies has become quite challenging. BA data reveals that in 2022, the total amount of global biopharmaceutical investments and financings decreased by approximately 38% year-on-year, and the total amount of medical device investments and financings fell by around 35% year-on-year. Following the incident, 325 venture capital firms and 650 founders jointly declared that Silicon Valley Bank must not fall. Moreover, since 2022, news of unicorn companies collapsing has been coming one after another, with some popular sectors witnessing a mass extinction of unicorns. Overnight, it seems like the entire world is facing a shortage of funds. In the same week that Silicon Valley Bank experienced a bank run, Embark, an American self-driving truck unicorn, announced its closure, with 70% of its employees being directly laid off, and the remaining 30% handling the company's shutdown process. In an email sent to the entire company, founder Alex Rodriguez stated, "Capital has abandoned us. We cannot raise funds." In comparison, the decline in financing for the biotechnology sector in China has been even more dramatic. According to CV source data, compared to 2021, the number of financing events in China's healthcare industry has dropped by 38%, while the total amount has plunged by 54%. Most biotech startups are unprofitable and have no revenue, and in this cash is king era, cash reserves can directly determine whether a company can achieve sustainable growth or even survive. The aforementioned investor believes that until the valuation system is readjusted, it will be difficult for the financing situation in the biotechnology sector to experience any fundamental improvement. In the current market situation, it is crucial to maintain sufficient patience and confidence. For companies, the advice is to reserve enough funds to support operations for 3 to 5 years, and to decisively cut off any unnecessary pipelines. In comparison, the decline in financing for China's biotechnology sector is even more dramatic. CV source data shows that, compared to 2021, the number of financing events in China's healthcare industry has decreased by 38%, and the total amount has dropped by 54%, essentially halving. Biotech startups are typically unprofitable and have no revenue. In this cash is king era, cash reserves may directly determine whether a company can develop healthily or even survive. The aforementioned investor believes that it is difficult for the financing situation in the biotechnology sector to fundamentally improve before the valuation system is corrected. Embark, which went public through a reverse merger in June 2021, reached a peak market value of $36 billion. It is at least the second high-profile unicorn in the autonomous driving sector to collapse since 2022, following the bankruptcy of L4 autonomous driving unicorn Argo, which was invested in by Ford and Volkswagen. In the biotechnology sector, there have been at least 4 notable company bankruptcy events since 2023. On January 6, Nabriva, a company engaged in the development of innovative anti-infection drugs for the treatment of severe infections, was reported to have shut down. On January 9th, renal cell carcinoma drug developer Plethora Biosciences announced the dissolution of the company and the liquidation of its assets. In the current market, it is crucial to maintain sufficient patience and confidence. For businesses, the advice is to reserve enough funds to support the company for 3 to 5 years and to decisively cut any unnecessary pipelines. On January 26th, Theonis, a tRNA drug development company, announced its closure due to disagreements among investors. On January 27th, Goldfinch, a kidney disease biotechnology company, declared bankruptcy as a result of fundraising challenges in the current macroeconomic environment. These 4 biotech companies that collapsed in early 2023 all had impressive backgrounds. Nabriva was spun off from pharmaceutical giant Novartis. Goldfinch's founder was a former senior vice president in charge of early clinical development at AstraZeneca and had raised a total of $210 million since its establishment in 2016. Theonis's founding team included professors from Harvard University and MIT, all of whom were pioneering scientists in the field of tRNA epitranscriptomics. Web3 and the metaverse were supposed to be the hottest innovations of 2022. In the second half of 2022 alone, at least 8 cryptocurrency unicorns filed for bankruptcy, including the once second-largest cryptocurrency exchange in the world, FTX, which had a market value of up to $32 billion. Globally, the number of unicorns is rapidly declining. Data from CB Insights shows that from the first quarter to the fourth quarter of 2022, the number of newly established unicorns worldwide decreased by 85%. At the same time, massive layoffs are sweeping across the global tech industry. Layoffs.fyi, a project tracking layoffs mainly in North America, Europe, and India, recorded a total of 280,000 layoffs from 1,300 tech companies worldwide in 2022. once highly sought-after high-valuation head companies suddenly found fundraising to be particularly challenging. Data from EY shows that in the United States, there were more than 70 fundraising deals worth over $100 million every month in 2021. But in the fourth quarter of 2022, there were only a little over 10 such deals. In the VC market, the world's two largest tech VCs, Tiger Global and SoftBank Vision Fund, significantly reduced their investments. Tiger Global significantly scaled down the size of its new VC fund, while SoftBank Vision Fund not only almost halted its investments, but also sold off assets at a loss to recoup cash. On March 2nd, SoftBank Group carried out its third reduction of its SenseTime stock holdings, selling 9.79 million shares at a price of HKD 2.5 per share. SoftBank's investment cost in SenseTime during the D+ round was around HKD 3.2 per share. As a result, SoftBank endured a net loss of 30% in the forced divestment. The day after the Silicon Valley Bank's sudden failure, media reported that some depositors were attempting to sell their deposits at a significant discount in order to raise